Welcome back to our channel, where we discuss everything you need to know about investing and building your wealth. In this video, we'll share the top 5 asset classes you need to know about making smart investments and securing your financial future. With so many options available, it can be overwhelming to make the right choices. But don't worry, we've got you covered. Our expert insights will help you understand the different asset types, their risks, potential returns, and how to manage them effectively. Whether you're an experienced investor or just getting started, this video is for you. What are the different investment asset types? Investing your money wisely is crucial to building wealth and securing your financial future. Let's take a look at the different type of assets you can invest in. These 5 asset types are namely: 1. Cash. 2. Stocks. 3. Bonds. 4. Property. And 5. Commodities. The first asset type is what we know of as cash. Every country has its own currency. And the value of currency in your country is relative to the strength of currencies in other countries, depending on the supply and demand. As we know, money is used to buy things that we like and services that we enjoy using. There are many factors that determines the value of a currency relative to other currencies, namely interest rates, economic performance, political stability, trade demand, and market sentiments. Basically, when more people need the currency to import goods from a specific country, they will buy and hold more of it, which will lead to for this currency to grow stronger. And when people import less goods or are less willing to hold a country's currency, that currency will weaken. As such, if you want to make money by holding cash, then you'll need to determine if the currency is going to appreciate or depreciate relative to other currencies. And you'll also have to consider if it makes sense to invest in equities or bonds so you could participate in capital growth and dividend or coupon income along with the currency appreciation. The second asset type is what we know of as stocks. When you buy a stock, you buy a part of a business. So, if a company has 100 shares and you own 1 share, then you own 1% of the company. The company can be traded on the stock market or held privately. Approximately 80% of companies are held privately and 20% of companies are held publicly, listed on the stock exchanges. If it's held privately, the value of the company is determined privately between the person selling and the person buying. If it's traded on the stock market, its value is determined by the price as provided by the demand and supply dynamics which drive its price. When more people buy the stock, the price rises. And when more people sell the stock, the prices fall. So, for example, more attention on a sector or a stock will drive prices up if people believe the stock will rise. Prices will drive down if people feel the stock is going to do badly and they sell based on what they feel. The third asset type is what we know of as bonds, which most people believe to be a safe asset to hold because of the nature of the asset class. However, is this really true? When you buy a bond, you become a lender to the company who issues the bond. You lend the money to the borrower in return for periodic interest payments, which are typically half-yearly, and at the end of the loan period, the money will be returned back to you. So, bonds are also traded in the market, which is called the bond market, and also influenced by supply and demand. So if people feel that the bond is going to be defaulted on as the company is unlikely to pay back, then the price of the bond will drop. However, if people feel that the bond is a good deal relative to new issues, then the price of the bond will increase. Which is why when interest rate rise, bond price drop relative to new issues and vice versa. The fourth asset type is what we know of as property or real estate, which includes properties such as residential homes, apartments, and commercial buildings. These assets are often held within real estate investment trusts, which is also known as REITs. Property prices are influenced by economic conditions, interest rates, government policies, demographics, and societal development, and as private assets. Price is determined between the seller and the buyer in a private transaction, though it is recorded publicly. For REITs, price is also determined by market price, which is affected by demand and supply dynamics on the stock exchange. Investing in real estate, we make money through capital appreciation and receiving rental income. Similar to equities, the property price and rental income is dependent on the property. As such, it is crucial to purchase your property in growth areas where the income of the general population grows, so people are willing to pay more to live in the area, which translates to higher rental income and greater demand for properties, which translate to capital appreciation. The fifth and last asset type is what we know of as commodities, that refers to raw materials or agriculture produced traded on the various exchanges. This asset class includes energy such as crude oil and natural gas, metals such as silver and gold, agricultural products such as corn, wheat, soybeans, and coffee. Commodities are traded in two forms: the physical trading and the derivative trading of financial instruments based on the underlying commodity. The price of commodities depends on supply and demand, which are influenced by geopolitical events, weather patterns, technological advancements, speculation, and investor sentiments. Investing in commodities can serve as a hedge against inflation, as raw material prices tend to rise when inflation is high. It also serves as good diversification due to low correlation with other asset classes. However, a bar of gold is just a bar of gold. We're holding in anticipation of future higher prices due to what we perceive and believe about the economy. It doesn't provide dividend income, coupon income, or rental income. Together, these makes up the 5 asset classes, and based on the economic conditions, we can determine which asset class we would prefer to allocate more exposure or less exposure to, and also to diversify our portfolio to manage risks and potentially increase returns. If you enjoyed our video, don't forget to hit the like and subscribe buttons, and turn on notifications to be informed of our next financial video. See you next time!